Welcome to the September 2024 monthly MOTR Checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. We have, as usual, a ton to get through this month. There's a lot going on. I'm just going to give you a couple seconds here to review the disclosures. But the theme for the video this month is, I think there's a chance that we've got a good shot of a really strong bull market in 2025. And I think that would surprise a lot of people because most would presume, and arguably and understandably so, that we've been in a bull market since 2023, right around the banking crisis. And while that's obviously undeniably true, it has not been a very robust, broad bull market. And if this market begins to broaden out, we could end up seeing a rather powerful bull market in 25 that actually makes what we've seen over the past couple of years look moderate by comparison. So, the way we think about it is that our outlook is always driven by the data as it is today, without our own views or anything like that, just kind of really is doing the best we can to listen to the market. So we're not really thinking about how we or I or anyone else thinks about the data and what it might look in the future or days, weeks, or months, but what does it look like today? And importantly, when I say data, I'm not speaking about perhaps what you might think. I'm thinking specifically about the data that reflects the market's opinion, which always comes back to these inviolable things that must be in place for a bull market or a bear market. They're inviolable because again they must be in place, and they're basically these five inputs to the risk gauge, and it's price trend, relative trend, cross-sectional momentum, breadth, and volatility. And all I care about is what are those five things signaling, because ultimately that's the best way to measure what the market's opinion is. And again, it's the market's opinion that matters more than any other opinion. So I want to also point out that when we say data, I'm not referring to economic data or earnings data, valuation, demographics, or anything like that. And so therefore, by definition, we're also not referring to Wall Street's opinion of those particular data points. The only opinion that matters is that of the market. And I always say that the market knows everything we know. So whatever we think we know about this recession, whether it's a lock and it's definitely going to happen, or it's a soft landing, or whatever it is, the market already has processed all of that, which I think is a key message here. And it also has processed all the things that we admit that we don't know, but it's also, most importantly, processing all these things that we don't even know we don't know. And that all that information, that rich data, makes its way to the surface of these trends that we're measuring within the context of that risk gauge. And so as it stands, those risk gauge inputs have been driving the models to a good and getting better state for a couple of years. I mean, the conditions have been good. I've been identifying this environment as being bullish. I've been fully invested, no short exposure, and very little cash throughout the past couple of years, but it has not been robustly bullish. And I've been talking about this for quite a bit, almost to the point where I'm getting annoyed by it. But I'll show you a chart that goes back to the 70s that really demonstrates just how rare it is that the markets can be so disconnected between what appears to be happening on the surface and what's happening with the average stock. So as it stands right now, though, our outlook does remain bullish. And it will remain bullish as long as the data, as we describe it in the risk gauge, remains bullish. And so what I want to focus on in this video is touch upon some of the things that everybody seems to be most worried about, and forgetting even about what the risk gauge is saying, just demonstrate how those data points that people are worried about are actually perversely they're bullish, or maybe even one might even say meaningless, not worth expending brain cells on, because it's, as I'll show you, the data, that the economic data and GDP is just not a helpful timing tool. So as long as these things are these are all being processed by the market, and the market's opinion, which is the only one that matters, is what it gets reflected in these risk gauges. And I think what I'm trying to demonstrate here through this research and these models is how you can aggregate the data that matters most, those inviolable inputs, and then build a process around those inputs that guide you to help make decisions in what's otherwise a very uncertain world, because we'll never know the future. And I always say that the best opportunity of building a sustainable edge in the market is to actually understand the present and what's happening right now better than everybody else, because most people are focused on forecasting the future, which we all know is a fool's errand to begin with, to the point where while everybody's forecasting the future, they can't even tell you what's happening right now. So I think we're just better off just focusing on the present, focusing on what the market's saying right now, and then just continue to do that until things change at the margin. In reference to this, this disconnect between what's happening in the market, I think it is an interesting exercise to think about it this way. So if I told you that stocks peaked in 2021, and since then we've had a historic banking crisis, inflation has soared, bond yields skyrocketed, mortgage rates more than tripled. The Fed tightened aggressively, war in the Middle East, obviously ongoing in the Ukraine as well, many more things. And I just said all these things. What would you say that the stock market has been doing since peaking in 2021? And I think it would be fair of you to draw something like this, to say that this is probably something like what's been happening over the past couple of years. And it's fair to think that. I mean, it's a sort of a combination of the global financial crisis with all these banking crises, the skyrocketing inflation of the 70s, and of course the various periods of war throughout history that have caused a lot of turbulence in the market. I think it would be fair to assume that something like this has happened over the past couple of years. But what we of course know to be the case that has actually happened is, we did have a bit of well, it was a good cyclical bear market in the S&P and through here. Good almost a 1 year decline, about a 20%, more than 20% decline on the S&P. So it was definitely a good cyclical bear market, reflecting much of these things that we see here. But what we know about what ended up happening, at least for the S&P, is as the inflation was beginning to really heat up, the market itself continued higher anyways, and that was on the assurances from the Fed that the inflation, if you recall, was transitory. And of course, the Fed did an about face right about here when they recognized that the inflation was indeed not transitory, but was more, the greater risk was that it was here to stay, much like the 70s. And so that's when they really began to embark on their rate hike cycle, which of course caused that bubble in growth, the FTX implosion and everything else that happened, and of course the ensuing bear market that followed that tightening cycle, right up to the point where we had the banking crisis as well, right about here. And then since then, we basically have what appears to be a very strong, robust bull market on the record books, which is just astonishing when you consider all the things that have happened since throughout this what appears to be a bull market. But again, what I suspect, if you've been watching the videos and reading my research, you probably can tell what the next chart is going to be, which is a real true reflection of what's actually been happening. And I think it's some combination of what's the S&P says and what you might have thought would have been happening given these headlines. But this is that value line geometric average, which does a great job of telling us what's happened on average to the stocks within the market, roughly 1,700 stocks. And up until this moment, in early August, when we had that volatility crash, the average stock from the 2021 peak was still down 20%. So by any measure, we were still in a bear market. And I know that, and this is something I've been talking about, and it almost gets to the point where it's semantics, and it's like what difference does any of this make, because it's still a bull market. And I'm not saying, as I said, I've been bullish. I'm fully invested, no short exposure, no cash. But what I've been harping on is this idea that it's been has not been a robust bull market. And what that means, if you think about the index as being the car, and you think about the breadth of the market as being the gas, a car can only go so far as it has gas in the tank. And when you have both of these things moving together, when you have the S&P moving higher with breadth or with the average stock, you have a very robust, very healthy market. It's in these moments when you have these instances where the S&P itself is going out to new highs, but the average stock is significantly diverging, which is basically indicative of a car that's buzzing along the highway that's quickly running out of gas, and it's going to be in a very risky situation as it runs out of fuel. And the idea is that these divergences of this magnitude, of this is like almost a 2 or 3 year divergence between these two benchmarks, they don't happen very often, and certainly not of this magnitude. And when they have happened in history, they've tended to end badly. So here's a couple that you can see since the 1970s. This was, of course, the 1987 crash here. So this is the S&P 500. This is the value line. And as the S&P went to new highs here, we can see that there was a significant divergence, and in itself was also there was also sort of a nested divergence in here as well, where the S&P went to a new high here, but the breadth once again did not, all in the context of a bigger divergence, which gave way to the bear market of the 1990s, which I was invested in during the time, and I was an analyst at the time, and that was a really nasty bear market. It was also coincided with the war in Iraq. So this divergence was sort of the backdrop to that what ended up being, frankly, a 3 or 4 year rolling bear market period. Of course, we had the one that we all are perhaps most familiar with, which is the divergence into the peak in 2000, when the average stock continued to go lower as the bubble at the time continued higher, and of course this resolved quite variously, as we know. And the one, perhaps the divergence that was glaring, but perhaps lesser known, was the divergence that occurred right before COVID. And so this is back to the 1970s, and so there's not a lot of instances we can give that show divergences of this magnitude. And again, unfortunately, of the ones I've shown you, they've all ended anywhere from badly to catastrophically badly. Now, I do want to point out, with a little bit of good news here, that there was one instance during the European debt crisis where we did have a similar situation where the S&P went out to new highs, but the breadth did not. And in this particular case, the divergence resolved bullishly. And in the 35 plus years that I've been either an analyst or managing money, that resolution, and eventually when these two lines started to move together, indicating that the car had now a full gas tank, that was one of the most explosive bull markets I've ever managed through in my career. So it happens that although most of these have ended negatively, I actually think the data supports the idea that this particular one will end positively. And that's because that's what the data says right now. That's not a forecast. It's just identifying what is today. And of course, I'm going to walk you through that. Thanks so much for watching this clip of the monthly motor checkup video. We appreciate your interest in our research, and we hope that you are finding it helpful and informative. If you'd like to continue watching this video, as well as access our most recent monthly motor checkup, sign up for a free 30-day trial to all of our research at motorcmr.com. You'll find a link to our website in the description below. As always, like and subscribe to be notified of future content.